So let me kick off. As we've already heard, and I won't regurgitate all the slides that we've seen earlier on, the market is in a tricky place. There are a number of transactions that happened earlier this year, but in the second half of the year, the expectation is that there isn't going to be a huge amount going on, and nothing has happened in half two so far in Saudi. We've heard about the reasons for that, the volatility in the markets, the influence from outside of the region, also declining corporate earnings. But ultimately, as we all know, the market will come back at some point. And as IPO advisors, we need to help companies prepare for the event. And we all know that it can take some time for that preparation process to happen. But I want to take a step back before we get into the preparation process and just talk a little bit about why it's important that we have an IPO market and the benefits for the broader economy. So just to start with, I'll hand over to Fahad just to talk about the advantages of us sitting up here talking about IPOs and what it does for the region and for the economy.
I think IPOs are important because they simply increase investment in the economy. Most of the events that we've seen for issuers coming to the market are either going to be monetization events. So family groups, for example, who are looking to monetize partially their stake. And in many cases, they actually reinvest that back into the economy in other companies in their portfolio or other areas that they think have higher potential for growth. Or simply in some companies, and this has not been the majority of cases, but some companies have actually come to the market to actually raise capital for growth. And again, I think this is something that you would expect in more mature markets for IPOs. But in both cases, I think they both facilitate investment in the economy and further growth. And I think at the time where there is more emphasis on the private sector for growth and to drive the diversification agenda, I think having more IPOs that facilitate additional investment in the economy is something important, and it's incumbent upon us as market participants to actually facilitate the process.
And do you think, I think the impact of foreign investors being allowed into the market is something that will be seen as a significant positive going forward, but the impact so far has been somewhat limited, most likely due to events outside of control. But can you talk, Robert, perhaps a little bit around your experience of the impact of QFI, and also, most importantly, what else can be done to improve liquidity going forward?
Sure. I think it's interesting. I was in London recently and had a number of discussions with institutions there. I think Saudi remains one of the unknowns still amongst a lot of the institutions, and some of the questions were around the level of CMA regulation. Obviously, as you may know, when you become approved as a QFI, you become subject to CMA regulations, and not only that, you have to have an understanding of the regulatory environment here. You need to understand the insider trading rules, etc. So I think there's been a lot of press about whether the QFI initiative has been successful or not. Most people are saying that it's been a little disappointing in terms of the level of engagement, the level of participation. But I think we've also got to put this into perspective. It's the next step in the evolution of liberalising the market. So obviously the swap agreement 5 years ago was the first step. The next step is now introducing the QFI regime. Some of you may have heard that Mohammed Al-Ajlan has recently said that, look, we've introduced it, it's been implemented. If it's not working, we're open to making some changes. And I think one of the key objectives, of course, is to qualify the Saudi market for admission into the Morgan Stanley International Index. So, and one of the hurdles that I think we're failing to clear right now is the market accessibility test. So right now, I think there's a view that the restrictions in terms of the size of the institution, funds under management, these sorts of things, means that the bar has been set too high in terms of criteria, which means really the market is not deemed to be accessible to foreigners to the extent that most people would have hoped.
Sandeep, you were nodding. Do you have any other perspectives in terms of how the regulators may take this further and improve the situation?
I think from what Fahad mentioned, of course, a lot of family companies who keep waiting to come into the market, and that definitely has a lot of beneficial effect for the overall economy. But in terms of the motivations, Fahad mentioned two of the key motivations that a lot of these family companies have. One is monetization, and second is to access growth capital. I think another factor which is often missed is that a lot of family companies also look for public markets because of certain complexities that they face while they are going through generational changes. So a lot of these companies who are in second generations, who are taking over the management, they may have the family tree which might have expanded. There would be some members of the families who will be in the business. There will be others who are outside of the business, but they're expecting certain dividend flows, etc. coming in. And there might be some tensions, which sort of positive tensions at many times, and sometimes more competitive ones, which might be there in terms of the governance structures that the wider family might expect. And the IPO in many ways helps achieve those objectives also for the company, to have a transparent mechanism to put in place those governance structures. So that is one important element, and I think that is where the QFI is a very, very positive step in our view. Because what we see is that if you're looking purely from a monetization perspective or growth capital perspective, the valuations generally, you can time your time to market, you can get probably good valuations, you can also get access to that liquidity. But what becomes more important is what happens after IPO. And if you are looking to raise your profile and you're looking for those stability mechanisms to come in, then stability of the market and reflection of the valuation sentiments in the market and having that broad breadth becomes very important. Now what we see, just to put one case in point, what we have seen is that after the recent events, there have been a negative sentiment that got built in the market. We have seen the overall, the TASI, the all share index have come down a certain percentage. Of course, there are a lot of concerns which might be there from energy prices, etc. And some sectors would of course will have that negative impact which may come in, but not all sectors are impacted the same way. When we look at the food and beverage and some of these consumer segments where we have not seen any impact of this, of let's say the oil and gas. In fact, some of the companies that I watch very closely are having their best year in recent memory in 2015. But that sector also has taken the plunge pretty much in line with the overall share index. Now this, in our view, happens a lot because there is an overwhelming presence of retail investors in the trading, which is probably supported by less research than what it should be. So from family companies, they would like to see presence of longer term investors also, who would be more research based, who will be more differentiating between companies and sectors. And that essentially would also serve that particular objective which many companies may have.
I mean, are you seeing the same with the companies that you're talking to in terms of the ways that these companies are talking about potential changes that might happen in the future, and how that might benefit the overall capital markets?
In terms of changes, you're referring to changes in the regulations or in the...
Yeah, I mean, if you had a magic wand, what are the kinds of things that you might do to improve the market operations?
Basically, from a CMA perspective, we have seen that the CMA has been improving, and they always strive to improve their listing rules and regulations so it can facilitate and shorten the approval process. For example, the approval process for IPO applications, it used to go into 1 year or more. Now it's a matter of 4 to 6 months. So this helps a lot in the IPO applications. Currently, also the CMA is having some thoughts on on also improving the listing rules, and especially in regards to the participants of the IPOs and rights issues. Now they are currently focusing on having, and we've seen it historically in the recent IPOs, that they focus on having funds participating in a percentage larger than before. So these are the key changes, and CMA always strive to look for changes. They always speak to APs in order to improve their listing rules.
Robert, any other thoughts on this area?
Sure. I think it's interesting. One of the prevailing themes today has been obviously IPO activity is low, but I think CMA activity is high, which is encouraging. And at the beginning of this year, the CMA released a strategic plan for the next 5 years, where it underlines some of its priorities, and some of the things that Ameen had just mentioned have been on the list. But not only have they been on the list, but the CMA is now really doing something about it. I think a couple of other measures that the CMA is looking at in line with its priority or objectives of improving the market to meet international standards is they're looking at price stabilisation as a possible feature of the market. They're also looking at pre-IPO research. You know, all of these things are hallmarks of what we would consider a mature market, and I think these are things that would be very much welcomed in Saudi. So, I mean, again, whilst the activity in the market is low, I think when it picks up, perhaps we might see a slightly different environment and a much better one.
And Fahad, do you, in terms of the way that JP are looking at the market, what's your expectation for 2016 and this potential new reality that Robert's talking about in the regulatory environment?
Before that, I wanted to make a quick comment on the QFI regime. I think at this stage it may be premature to judge the QFI experience. I think the period was too short. I think there's a lot happening in the market backdrop that may have impacted the investors' participation, primarily the oil price drop. However, you know, what I would say is that foreign investors represent roughly 1% of the market today, and that is equivalent to the size of the domestic mutual fund managers. So in terms of size and institutional impact, you could argue that they are significant. And if you look more closely, the QFI investors have not been distributing their investments evenly across companies. They are very selective, and you'll find higher concentration of foreign investors within particular companies, and not so much in others. And what we found that the companies who've managed to attract the foreign investment have managed to outperform in the secondary market post-IPO compared with those who have not. So I think the foreign investors are playing a role in the market despite their smaller size. I would suspect that the participation will move higher going forward, and we will be better to assess the experience by then. Now, with regards to the pipeline going into 2016, I think it will very much depend on the market backdrop. I think we need a period of stability around prices, which has been quite volatile recently. And I think once that occurs, I think that will be encouraging for companies in certain sectors to come into the market who tend to be much more resilient in terms of the underlying operating performance, and will be quite attractive for investors to come in.
And are there particular sectors that you're seeing this interest for future planning and IPO preparation as we stand today?
Yes, I think we see healthcare being an attractive industry to market participants. Consumer continues to be an attractive area as well. Food and beverage also is an attractive area. So I think certain sectors that have demonstrated that they are resilient in terms of underlying operating performance, will find the next window of opportunity to be conducive for them to come to the market.
How does the panel feel about the increase in global private equity interest in Saudi, larger deals potentially being contemplated? So far, most of the companies that have come to market that are private equity backed tend to have been minority stake investments. Do you think that the environment in the future will allow for more strategic majority stakes from the larger PE houses to facilitate effective exits?
So, we've seen the first majority PE-backed transaction already occurring, and that's interesting to follow. But as you correctly point out, the majority of transactions continue to be minority for international PE firms or regional. And I think there is a bit of ambiguity, I think, around the exit and the ability to fully divest a stake in the public markets, which creates some uncertainty for certain investors to come in.
And the expectation around lock-in period. Ameen, I know we were talking about this previously. There doesn't seem to be any sort of standard.
There's no standard lock-up period for the founding shareholders as opposed to PE investors. What we've noticed in a couple of deals that a private equity investor was there as a minority shareholder, that the lock-up period differs between the founding shareholders and the PE partner. The private equity partner usually has a lower lock-up period. In relation to PE companies with a PE partner with higher ownership, one thing to consider is that people would assume that with a high percentage of controlling stakes for the private equity is that they are controlling management. And investor would be considering that when this private equity partner exits, how the management will be. So it's important to make sure that management, sorry? Sure. So they need to make sure that the management is well in place and they can operate properly even after the private equity partner exits.
Robert, any thoughts?
Yeah, sure. I think, I mean, obviously, in the IPO context, the private equity investor is looking for a quick exit at a good price, and obviously, there's a risk that during the course of the IPO due diligence, perhaps certain issues are uncovered that the CMA are just not going to suffer without first being fixed. Or market conditions change, the cost of the process is expensive. So what we're seeing is a couple of clients are considering a dual track approach. I don't think it may not be possible to follow the dual track approach in the traditional sense of the word, in terms of running an auction process simultaneously with the CMA reviewing your prospectus, because I think there's a fair expectation by the CMA that once you're committed to the IPO process, that you are committed, in fact. But I think that it certainly makes sense to have the M&A exit as a second option up your sleeve. And if you get to a point with the prospectus drafting, the due diligence, where it's clear that for whatever reason the IPO is not going to work, then it's entirely possible to convert the process. I think I wouldn't say easily, but quite achievably into an M&A approach. For example, as we all know, the IPO due diligence report is a very comprehensive review of the company, and it's probably a step beyond what you might do in the M&A context. And not only that, of course, with all the work you do on the prospectus, you can convert that into a very nice IM. So effort not wasted.
Fahad, do you expect to see a similar kind of trend? Companies keeping their options open? Is that the right advice in this sort of market?
Well, I think it will depend on a case-by-case basis. I think the majority of cases will be for partial sales, for companies going or sponsors going and accessing the IPO market. I think maybe in certain situations where the sponsors are looking for a higher maybe percentage of sale, a dual track will make more sense, primarily for financial sponsors. I think the idea may be more attractive for them. I would suspect that the majority of issuances will continue to follow either of the tracks.
I was interested to hear earlier on about the proposed new companies law, and in particular, exciting as an advisor to hear that some of the rules and regulations that drive the listed companies are being pushed down onto private companies, family businesses. Sandeep, I just wanted to get your perspective, given that you've been on both sides. This is one area where I see that the process to get a company ready for the markets is going to be shortened. What are the other challenges that you see from within a family business in terms of getting ready for a transaction, if that was considered in the future?
I think from the perspective of regulations, sort of trying to drive the family businesses towards a particular kind of governance structure, I think any family business that would be looking to access the public markets has to accept that they have to go down that path. So I don't see a massive impact on those companies who are looking to access the public markets for this. However, it would definitely make the general sort of private equity market more vibrant. That definitely is a benefit, and you will have a lot of collateral benefit that will come out of that, with sort of more players, more educated players, and having more options with them, and hence eventually more differentiating customers in terms of trying to value the companies based on the better practices that they follow and the better fundamentals that they have. I think on the previous point that was being discussed, I think it's a dual track possibility in true sense would enable the family businesses and the owners of the businesses to retain options with them, rather than being given sort of in a sequential manner a set of options for them. The companies approach private equity either from a monetization perspective or in a process to build up a certain valuation, certain governance practices in the process of getting towards the full public market listing. The private equity, of course, needs to have a clear exit for them, because that's the structure that demands. And if you have options available only in a sequential manner, then typically that turns out to be more stringent for the company. That might be more expensive proposition, and that somewhere restricts also the overall private equity markets which are available. So having more options available with the companies in terms of how they can plan the exit and how they can provide the exit, that would, in our view, help the overall liberalization of the market, both from private equity perspective as well as from the public equity perspective. More companies looking to go down that path because they will be able to control. Another point could be the liberalization, which we think is very positive, is on the book building side. So your ability to choose what kind of investors you would want to, your ability to choose when do you go into the market, what path do you want to follow, these will have a wide-reaching benefits for the overall market. That's what we think.
Let's see what the CMA has to say about that in due course. But from my experience, the dual track process often allows you as advisors to identify pretty early on that actually the company is nowhere near IPO ready, and that there are a lot of roadblocks, as you mentioned. From the other panelists, are there any particular sort of roadblocks that you've seen in recent deals that have caused you to believe that actually the right advice is not to explore an IPO at this point, but actually to look at other options? Anything that comes to mind?
I think what comes to mind is sometimes the issues.
You might need to lift your microphone.
The issues around concentration. So for example, if there are concentration revenues to a certain customer, if there are significant exposures the company has, and that may not be achievable to diversify the revenue base over time, or in the envisaged timeline, then it becomes more palatable for the sponsors to sometimes think about private sale option as opposed to the the IPO process. I think we were involved in such a situation, but in terms of IPO readiness overall, I think we are generally more exposed to the larger corporates who tend to have larger financial resources and have invested quite heavily in their personnel and tend to have considered the IPO for some time, and therefore, in many cases, we find that sometimes that they're more ready than we have initially anticipated.
Yeah, just to pick up on the obstacles point, I think what's interesting is in our experience, traditionally this market and the CMA's role has been very retail orientated, to the extent that the CMA takes its responsibility very seriously to ensure that retail investors are protected, that obviously there's full disclosure, but there are certain obstacles such as compliance issues, for example, where companies have subsidiaries in other jurisdictions and there's some sort of nominee arrangement which is perhaps not compliant with the law there, but perhaps in that particular jurisdiction it may be normal market practice. The CMA will nonetheless often insist on that issue being solved. Whereas if you're looking at the M&A context, the purchaser may take a view on that and be perfectly ready to accept that risk because they've got a better understanding, or maybe they have a different risk appetite. So it's a sort of an interesting...
Well, they're used to working through that tidy-up process in preparation for an event.
Yeah, I mean, they can do the deal and sort it out later, whereas I think obviously when you're coming to the public market, you know, the preference is to come as a sort of a clean skin, as it were.
Yeah. Before we take any questions, one theme that we're seeing in Saudi is the increased activity around rights issue planning for a variety of reasons, for regulatory reasons, to delever, for acquisitions. I think the point raised earlier on about public companies looking to acquire business to sort of bolster their earnings, bolster the growth prospects in different geographies and markets. Are you seeing a similar trend, and what's driving that trend? Fahad, maybe if you want to start.
Sure. So you know, with the weak equity market in general, corporates will find that rights issues are quite an expensive form of capital. And I think so far the activity this year has been driven by regulatory considerations, primarily in the insurance sector. I think we'll find other drivers to drive rights issue activity, potentially companies who are looking to delever, potentially companies who are looking to further invest in their business in this environment and find it attractive to do so. Will go to the market and issue through rights offers. With regards to cross-border M&A, I think while certain companies have and continue to consider the option, I think it will be very much dependent on their ability to finance a transaction, and I think my general sense is that issuing new shares to finance an acquisition is usually not the preferred option for most companies.
Just my question to Ameen. I know Samba has been involved in many IPO transactions and been approaching CMA. In the past, as you remember, probably the valuation is highly impacted by CMA. Until recently, CMA has given a lot of flexibility, empowering the institutional investors to make a judgment over the valuation. When this change happened, do you see more, due diligence on the valuation from the institutional investors comparing to previous, where the valuation was just set based on multiples?
In terms of valuation now, even before the CMA, when the CMA used to interfere in the valuation, usually it was always compared to market, and the price needs to be always at a discount to market. So afterwards, they limited their intervention. Now, nonetheless, even with the CMA's reduced intervention, the financial advisor and the company make sure that the valuation is reasonable nonetheless. So again, we need to compare it to market. You need to compare it to the market comps of the company. So we've noticed that, of course, when the regulator reduces an intervention, you will find some more due diligence from the participants. But nonetheless, the price that we offer is always reasonable and always take into consideration the comps and the market PE.
Assalamu alaikum. Faris Al-Ghannam من HSBC. Maybe comment on what you said, Ameen, with regard to valuation. I think the reality is the process is still restricted to certain type of investors, which naturally put pressure on the price. If you can only go to certain type of investors, you cannot really go to the entire market. Yes, with less intervention from the CMA, but you eventually achieve the same goal, and that is to make sure IPOs are deeply discounted, which, to be honest, and most of us here are practitioners, is an issue for the industry. And I think this came implicitly in many comments in the panel. But the IPO market is significantly disadvantaged, I would say, in this country, for many reasons. Most importantly, this restricted process of pricing and allowing different or the right investors in an IPO to be accessed. Hence, you see this jump in aftermarket performance, because artificially CMA is pushing down the prices. Now, there are trends of faster or quicker process of review. These are all actually very positive development. But I think I wanted to make that implicit impression in the panel, more explicit, if I may. Would like to hear your views, that the IPO market, although we all believe has the potential, etc., in the country, is actually still in its infancy due to that way the market has been restricted, disadvantaged compared to normal equity markets. And I would like to hear what you think about it. Another thing, and it's related to this, because I think many of us here have been consulted about a new IPO framework by the CMA, which is, again, a positive thinking from the CMA to really share their thoughts up front and sound opinion from the market, and it's still in the working. So this is my second point. You would like to hear, especially on the banker side, your thoughts about this new framework and how it's going to impact the IPO market.
In terms of the CMA intervention, as you rightly mentioned, our market is still not mature. And I believe personally that this is part of the reason why the CMA keeps controlling the market, and especially on the pricing side. So nonetheless, the CMA, and as you know, the CMA keeps trying to develop its regulations so it can help the market to mature, basically. The other side of the market is the market participants. Also, there's a role that they need to have in terms of determining the price, and not just depending on the regulator on the pricing, and they will have it as guaranteed price. We will have limit ups for the coming few days, and then that's it. So I think at both sides it needs to be mature, from participant side and from the market side. Sorry, what's the second point? Or the others like to have any other comment?
Yeah, I think I would agree with both previous statements. I think in the past there was a significant emphasis on looking at IPOs from the lens of the retail investor, and if you look at markets globally, there is a competition between exchanges and markets to attract issuers as well as investors. I think we need to strike a balance. We need to start to listen to what issuers and their concerns, and I think one of them has been around the valuation, and I think this is very evident in the numbers. If you look at the size of the IPO funds that have been marketed to investors as a very low risk type of investment vehicle, which is contrary to the idea. But it managed to gather significant assets under management. I think I can't recall the figure, but I think it's roughly 25% of all equity mutual funds. So it's substantial AUMs that have been gathered in a short period of time, marketed to investors as low-risk opportunities to make high returns, and that comes at the expense of issuers. So I think there is a balance that can be achieved, and ultimately to develop the market, striking that balance will be important.
Yeah, I'd just briefly add to that. I think the development of the market, I think some people are pinning their hopes on the QFIs, and I think, as Fahad mentioned earlier, he's absolutely right. We haven't seen, it hasn't been enough time to see whether the plan is going to work, and the plan is simply that with more sophisticated investors who have higher expectations of the issuers in which they invest, they want to see better governance, they want to see better disclosure, they have different expectations, and hopefully they'll drive a change in market practice amongst the companies they invest in. And then I think other investors who are investing in companies without QFIs will have a legitimate expectation that their companies do the same. And so maybe hopefully this will drive the change, and without the CMA having to push so hard.